Look at this chart, right here. This massive red arrow pointing down at $75. This isn't just another price drop. This is potentially the setup for one of the biggest short squeezes in the commodities market this decade. And here's what makes Monday, January 5th absolutely critical. Multiple major banks are sitting on short positions right at this level. And if silver reclaims $75, we're talking about a potential market event that could make the GameStop squeeze look like a warm-up. In the next 15 minutes, I'm going to show you exactly what's happening behind the scenes. The manipulation that's been documented and proven in court, the supply crisis nobody's talking about, and why the setup is potentially more explosive than anything we saw in 2021. Stay with me, because the evidence I'm about to present, it's all public record, and it's damning. All right, let's start with the setup you're actually looking at here. Silver has been consolidating around this $75 level. And this wasn't just resistance. This was a battle line that's been tested multiple times over the past weeks. But then it broke. Hard. Silver crashed from 75 all the way down to 71.95. That's a 4% nosedive that happened with massive volume. Now, here's where this gets interesting, and where most retail traders get it completely wrong. When you see a breakdown like this, conventional technical analysis tells you support failed, price going lower, get out. But that's exactly what the institutions need you to believe. Because while retail was panic selling at 72, something else was happening in the derivatives market. Banks had been accumulating short positions around the $74 to $75 zone for months. Let me explain what that means in an easy way. When you short silver, you're borrowing it, selling it at today's price, and betting you can buy it back cheaper later. It's a bet that price goes down. Here's the problem. Your potential losses are unlimited. If you short at 75 and price goes to 90, you're losing $15 per ounce. And we're not talking about a few thousand ounces here. We're talking about positions measured in hundreds of millions of ounces. So these banks desperately need silver to stay below 75. It's not just about profit. At this point, it's about survival. Now let me show you the technical setup that everyone's missing. Look at this price action carefully. That dropped to 71.95. That is not organic selling. That's what's called forced liquidation. How do I know? Three things. First, the velocity. Price didn't slowly drift down. It collapsed. That's algorithmic stop-loss cascades. One stop triggers another, creating a waterfall. Second, volume patterns. When you see massive volume spikes during sharp moves, that's not patient sellers making rational decisions. That's forced liquidation, margin calls, computers dumping positions. Third, and this is the smoking gun. Look where it stopped. Exactly at 71.95, right at a major support level from earlier trading. Then immediate bounce. This is textbook bear trap. In technical analysis, we call this a spring. Price breaks support, shakes out every weak hand, triggers every stop loss sitting below that level, and then springs back up like a coiled trap. The amateur traders are now out of the market, nursing losses. And the professionals who understand this game, they're loading up. Because if silver reclaims 73.50, and especially if it breaks back above 75, every single one of those short positions is now underwater. Bleeding money every single day. And here's where the mechanics get really dangerous for the shorts. When you're short and the price starts moving against you, you have three choices. Choice one, hold and pray it comes back down. But in commodities, carrying costs are brutal. You're paying interest, margin requirements keep increasing, and every uptick is costing you millions. Choice two, double down. Short more to try to push the price back down. This works until it doesn't. And when it doesn't work, you blow up spectacularly. Choice three, cover. Admit defeat, buy back what you sold, take your losses. Now imagine it's not just one trader making this calculation. Imagine it's multiple billion-dollar banks, all with similar positions, all hitting their risk limits at roughly the same time. That's a short squeeze. And in silver, these moves are absolutely brutal. Okay, now let's talk about the elephant in the room that mainstream media refuses to address. Bank manipulation of silver markets isn't a conspiracy theory. It's documented legal fact. And I'm going to give you the receipts. September 2020, the United States Department of Justice announced that JPMorgan Chase agreed to pay $920 million to settle charges of market manipulation. Let me repeat that. Almost $1 billion, the largest fine ever imposed by the Commodity Futures Trading Commission. For what? For something called spoofing. From 2008 to 2016, JPMorgan traders placed hundreds of thousands of fake orders in the silver market. Orders they never intended to fill. The sole purpose was to deceive other market participants and manipulate prices. This wasn't some rogue trader. The court documents Show this went all the way up to the global head of JPMorgan's precious metals desk, Michael Nowak, Greg Smith. These weren't junior employees. These were the people running the show. And here's the kicker. JPMorgan wasn't charged under normal fraud statutes. The Department of Justice charged them under RICO, the Racketeer Influenced and Corrupt Organizations Act. You know what RICO is normally used for? Mafia cases. Organized crime. The government literally treated JPMorgan's precious metals desk as a criminal enterprise. Both Nowak and Smith were convicted. They were sentenced to prison, real prison time, for manipulating silver markets. Now here's what should terrify anyone short silver right now. Those convictions were for manipulation that suppressed prices. They were pushing silver down to profit from their shorts. But you can only hold a beach ball underwater for so long. And we've seen exactly what happens when the pressure becomes too great. Let me take you back to January 2021, GameStop, a failing video game retailer, brick and mortar stores and dying malls. Hedge funds saw easy money. They shorted GameStop stock heavily, so heavily that by January 22nd, 2021, they had shorted 140% of the available shares. Think about that. They sold short more shares than actually existed in the market. They'd borrowed shares, sold them, then those same shares got borrowed again and sold again. The ultimate house of cards. Retail investors on Reddit figured out the math. If they just kept buying and holding, there weren't enough shares for the shorts to cover. Basic supply and demand. What happened next shocked Wall Street. GameStop went from $17 on January 4th to $483 on January 28th. In less than 4 weeks, a 1,700% gain. Melvin Capital, one of the biggest hedge funds short GameStop, lost over $6 billion. They needed an emergency bailout just to stay alive. And even with that bailout, they eventually shut down completely. Gone. Citadel and Point72 had to inject $2.75 billion to save them. And it still wasn't enough long term. That was stocks. You can always print more stock shares. Companies can issue new shares, but you can't print more physical silver. You can't just decide to create another 100 million ounces because you need it. Which brings us to the supply situation. And this is where things get truly concerning for anyone short this market. According to the Silver Institute's World Silver Survey 2025, the silver market just recorded its 5th consecutive year of supply deficit. 5th consecutive year. In 2024 alone, the deficit was 148.9 million ounces. But here's the really important number. From 2021 to 2024, the combined deficit reached 678 million ounces. That's the equivalent of 10 months of total global mine production. Just gone. Consumed, not coming back. Industrial demand hit an all-time record in 2024, 680.5 million ounces. And it's not slowing down. Every solar panel needs 20 grams of silver. Every electric vehicle uses 25 to 50 grams. 5G infrastructure, AI data centers, medical technology. Silver has the highest electrical conductivity of any element on Earth. You literally cannot replace it in high-performance applications. When you need the best, you need silver, period. And here's the secret nobody talks about. Unlike gold, most silver gets used and isn't recycled. It's in tiny amounts spread across billions of electronic devices. It's in solar panels that will be in service for 25 years. It goes into catalytic processes and literally disappears. Mine production? Basically flat. 819.7 million ounces in 2024. That's up less than 1% from 2023. So you have demand growing by 4% year over year. Supply growing by 1%. An accumulative deficit that would take nearly a year of global production to fill. This is not a tight market. This is a supply crisis waiting to detonate. And sitting on top of this powder keg, banks with massive short positions trying to keep a lid on price. This is exactly the same playbook the hedge funds ran with GameStop. Except the fundamentals here are actually worse for the shorts. So let's game out what could happen when markets open. Monday, January 5th, 2026. Scenario 1. The squeeze markets open Sunday night on Globex trading. Silver gaps up. Maybe there's news over the weekend. Doesn't matter what. Could be geopolitical, could be dollar weakness, could be nothing. Price opens at 73. The algorithms wake up, they see momentum, they start buying. 73.50. We're back above the breakdown point. Every trader who sold the breakdown is now underwater. Then 74. Some shorts get nervous. The smart ones cut early, but that buying to cover pushes price higher. 74.50. More covering. The momentum builds, then 75. This is the Rubicon. This is the line in the sand. Banks are now at break even or losing money on positions they've held for months. Stop losses start triggering. Risk management systems start auto-liquidating positions. 75.50. The momentum accelerates. Now you've got short covering plus breakout buyers plus FOMO retail. 76, 77, 78. In this scenario, we could see a move to $85 or $90 in a matter of days, not months, days. Remember, GameStop went from 17 to 483 in 3 weeks, and that was in a stock where they could theoretically create more supply. In silver, there's no cavalry coming. There's no emergency share issuance. The physical metal either exists or it doesn't. Scenario 2, the grind lower, or markets open weak. More selling pressure, silver breaks below 71.50 and heads to 70, then 68. Banks celebrate. They covered some shorts and profit. They add to positions. They're printing money. Everyone who bought the dip is now bleeding. They panic, sell at the worst possible time. But here's the thing about this scenario. It might be setting up an even bigger move later, because every seller at these levels is removing a weak hand from the market. And meanwhile, who's buying? Industrial users who need the physical metal, sovereign nations quietly accumulating, smart money that understands the deficit. The spring gets coiled even tighter. Scenario 3, slow consolidation. Markets open flat. Silver chops between 72 and 74 for days or weeks. Boring price action. This is actually the most dangerous scenario for shorts. Why? Because they're paying carrying costs every single day. Time decay works against them. Margin requirements don't go away. They're slowly bleeding. Meanwhile, any surprise news event, any catalyst, any unexpected development could instantly shift this to scenario 1. It's like sitting on a time bomb waiting for the timer to expire. So here's exactly what you need to watch Monday and this week. Level 1, 71.50. This is the absolute bottom. If silver holds above this, the bears failed. The breakdown was a fake out. Level 2, 73.50. Reclaim this with volume and we're back in bullish structure. The bear trap thesis confirms and momentum shifts. Level 3, 75. This is the battleground. Get above this and stay above this with conviction, and shorts are in serious trouble. This is where the real pain begins. Level 4, 78 to 80. If we somehow get here, it's game over. Full panic mode for anyone short. Margin calls everywhere. Forced liquidation cascades. But don't just watch silver, watch the dollar index. Silver moves inverse to the dollar. Weak dollar equals strong silver. Watch gold. Silver is gold on steroids. If gold is rallying, silver amplifies that move 3 to 1. Watch treasury yields. Falling yields are rocket fuel for precious metals. And watch the overnight Shanghai silver market. Sometimes Asia leads and New York follows. Now let me zoom out and give you the bigger picture. This isn't just about making money on a silver trade. This is about a financial system that's reaching its breaking point. When major banks get caught in manipulated commodity positions, when supply deficits hit 5 consecutive years, when industrial demand is growing faster than supply can keep up, when the people who are supposed to be providing liquidity to markets are actually rigging the game. Silver isn't just a trade, it's a signal. A signal that the games being played in paper markets are colliding with physical reality. A signal that you can manipulate prices on a screen, but you can't manipulate geology. You can't manipulate industrial demand. You can't manipulate supply and demand. In 2011, silver hit $49 and then got absolutely demolished. It dropped 30% in a few weeks. How did that happen? The Chicago Mercantile Exchange raised margin requirements 5 times in 9 days. They literally changed the rules to force liquidation. Many believe that wasn't a natural top. That was intervention. That was the powers that be saying, not today. But here's what they didn't count on. Every intervention, every manipulation, every time you hold that beach ball underwater, you're storing energy. And the longer you hold it down, the more force is required. The more pressure builds. Eventually, the energy required becomes too great. Your arms get tired. The forces of nature become stronger than your ability to suppress them. And when you finally let go, that beach ball doesn't just float back to the surface. It explodes upward with all that stored energy. Is Monday the day that beach ball gets released? Maybe, maybe not. But this setup, 5th consecutive year of deficit, proven bank manipulation, massive short interest, technical breakdown setting up a bear trap, this is exactly what you want to see before an explosive move. The banks are playing the same game they've played for decades. Suppress price through paper manipulation, while industrial users drain physical supply. But they're running out of time. Because on one side of this trade you have paper contracts, promises, IOUs, things that can be printed, created, manipulated. On the other side, you have physical reality, actual metal, actual supply and demand, things that don't care about your spreadsheet or your derivative position. And physical reality, it always wins in the end. The question is not if this resolves to the upside. The question is when. So keep your eyes on 75 this Monday. Keep your eyes on those banks and their short positions. Keep your eyes on the supply deficit that keeps growing every single month. Because when this goes, It's not going to be a gentle move higher. It's going to be one of the most violent short squeezes in commodity market history. If you found this valuable, hit that like button. Subscribe, because I'll be tracking this situation daily as it unfolds. And drop a comment. Do you think silver reclaims 75 this week? Or are the banks going to defend that level one more time? This is going to be one hell of a Monday. Let's see what happens. Thanks for watching. I'll see you in the next one.